Hi, everyone. Thanks for joining. Today, I am joined by Sam Amidi from our mortgage advisors. He's head of sales at Better. And it's been a little while since we've caught up, and the mortgage landscape has changed significantly, and it's kind of zigzagged all over the place. So I was really keen to get an update from Sam on where he sees things, and hopefully we can all learn a little bit from him. He's the man in the know. Sam, it's been a bit of a crazy time in your world, hasn't it?
Yeah, it has, Phil. Thank you, obviously, for having me on. I guess, yeah, since October, the market turmoil has been a bit of as you kind of mentioned, zigzag kind of environment at the moment. We're kind of at a period of stability. However, if you asked me this time last week whether I anticipated the base rate going up, my answer would have been no. But when I read the inflation results at the start of the week, that quickly changed my mind, and I kind of had a bit of a. But if I was to hedge my bets, I probably would have predicted that they would have increased the base rate this week.
Can I just take you back for the benefit of our audience?
Yes.
To that crazy time at the end of last year. Obviously, we are more interested in today and the future, but I'd be interested in your explanations, if you like, when the world was changing really rapidly, and the press were writing pretty sensational headlines about what was happening. And the mortgage products were being pulled left, right, and centre. Interest rates were rising. But my sort of understanding at that time is nobody knew what was happening. The banks didn't know what was happening. So what do? They don't actually want to. They're in business to lend money, but they don't want to lend money if they can't make any profit. So that was why they were pulling things off. But it looked pretty. It didn't look well. It didn't look good, did it?
No, I completely agree. The market at the point looked bleak. I guess there was no clear direction in terms of what way we were going to be pulled. Was we going to be pulled to an extent where rates were going to continue rising, or was someone, which obviously Rishi Sunak has come and kind of stabilised the ship a little bit, come in and obviously stabilise it and obviously move the kind of economy back to the direction we need it to move towards, where we're not moving towards turmoil. I mean, we're not moving towards what we had 12, 15 months ago. Absolutely not. But to try and, essentially bring a bit of stability in the industry for the consumer, really, and for the banks to be able to breed a bit of more confidence to release more products again, because the problem we had at the time is that lenders would pull products with no notification at the time. And it was quite a bleak time for, as I said, not just for the banks, but for us, the consumer, who are obviously the most important people.
Nobody wants to make these big decisions, whether to borrow money or indeed whether to lend money, or for you to advise someone what to do in a time of uncertainty. And things were changing really quickly. But as you say, it's a comfort to everyone.
Correct.
That things seem to have settled down a bit.
Yes.
What would your tips be now? People that are coming to you now going, what should I do? How do you see the landscape? What's your advice?
Yeah, so although base rate has obviously crept up to 4.25%, which is the highest it's been in roughly about 14 years now, my advice is don't delay. If there's a decent rate out there, secure it. Our advice to our customers at the moment is just because you've secured a rate, it doesn't mean you're tied into that rate up until you complete. You're not. Okay, so we encourage the consumer normally about 4 weeks before they're due to complete, whether it's a remortgage or a purchase, to engage with us, let us review the market again to see whether they're still on the cheapest deal. And if they are, great, it's a win-win situation. If they're not, we will put them back onto the best deal available.
So when you just said secure the rate, I immediately thought, oh, Sam thinks rates are going to go up, therefore secure it now. But actually, you're saying just secure it anyway because you don't have to take it.
It's a win-win. Correct. It's a win-win situation for you, right? You've got nothing to lose. If rates go up, you've secured a better deal. If rates do go down before you complete, you've got the option of changing that rate before you complete with that lender and go with a better rate.
I'm going to put you on the spot here, so forgive me, and you may well not know the answer. I'm just wondering what the long-term historical average of interest rates are. I bet it's not far from where we're at now.
No, I believe that the average will be floated around about the 5%.
There you go.
So yeah,
we've just got massively used to very low or cheap money. And those days have gone. But it's not actually expensive money now, is it? It's okay.
Yeah, it's probably not as bad as what people think it is. I think it's just a period of stabilization and understanding this is the norm. So if
Yeah.
you'd asked, if you know, was to take a mortgage out 10 years ago, these kind of rates were pretty normal back 10, 12 years ago. So, you know, consumers shouldn't panic. The rates are actually, you know, you've got sub 4% rates still out there on a 5-year fix, for example.
Mhm.
And as I said, you know, just because the base rate is at 4.25%, it doesn't mean lenders follow the base rate and set their rates above that. So there are still good deals available.
Okay.
And yeah, we are, as I said, these kind of rates are pretty normal. You know, this is what we call the norm, and probably will be the norm for the next kind of at least 6 to 12 months.
It's fair to say that it's the low rates and the cheap cost of borrowing that's actually fueled the housing market, isn't it?
Yeah, I agree with that. Totally agree with that. And even today, your average mortgage will still be roughly about £50 cheaper a month than you renting. And what people don't take into account, even though it is cheaper, is what you're paying off on your mortgage. The way I view it is you're paying off, so you're putting money into savings because you're paying off capital off your mortgage, you're building more equity.
Yeah.
So in theory, that the capital element you pay off on your mortgage is what you would naturally just put into savings. So it's, again, you're saving more than the £50 when you kind of put it into that perspective.
Good advice.
But yeah, on average, it's still cheaper to have a mortgage and buy a property than to rent.
There's been much written about large numbers of people coming off very cheap fixed rate mortgages, and I mean, yeah, that is true, but what's equally true is the house prices have risen. Correct. And therefore I'm presuming, tell me if I'm wrong, I was thinking, well, yeah, they're coming off their low fixed rates, but the house price has gone up, so they've got a big chunk of equity there, and therefore they're able to, presumably with your help, to have a bigger deposit and therefore get a better mortgage. Is that, or am I being naive?
No, I mean, you're kind of on the right path there. So yes, the bigger deposit you've got or the more equity you got, the better deal you can obviously obtain. Obviously, the kind of lower rates at the moment are still floating just sub 4% at the moment, whereas, you know, 24 months ago, those same rates would have been out between 1.2 to 1.5%. So from an equivalent point of view, we have obviously, you know, the landscape has changed a little bit where rates are, but yeah, absolutely. The bigger the deposit you've got or the more equity you've got, you will be able to secure a better deal.
So yes, it's right. When they come off their fixed rates, if they stayed with the product that they're on, their monthly costs will rise quite significantly.
Yeah, so I wouldn't. Again, it depends on the individual circumstance. You know, so someone, I don't know, 2 years ago took a mortgage out with a 5% deposit. Generally speaking, the rates at those periods of time were floating not far off the 4%. So if they've built enough equity now, which, you know, the prices would have probably increased by about 20% over that same 2-year period, or 15 to 20%, not far off, they would have built enough equity to be able to secure a rate not too far off that, too dissimilar. Whereas someone that was on a 60% loan to value deal had like 40 or 50% equity in their property or as a deposit, those individuals will probably come to more of a payment shock because they will be going from the 1.2, 1.5% rates up into the kind of 4% rates.
Yeah. Thank you, Sam. Thanks for clearing that one up. I know that is something that's been on lots of people's minds.
Yeah.
What in your day-to-day work? What is the trend of the moment? What types of mortgage are your clients tending to go for? Are they fixing? Are they going for trackers? Are they going for variables? What are they up to just at the moment? And of course, it changes all the time. But
correct. Yes, it's a good question. It's a good point. I mean, you know, the first things first, it depends on each individual circumstances. You know, you're kind of betting against the market is probably the easiest way for me to put it. You know, do you feel that rates will go down? But, you know, it depends on the economic levers that kind of drive the rate, you know, as to whether it goes up or down. You know, no one would have thought in October would be sitting there looking at lenders putting rates up to 7.5%. But, you know, fast forward 3 months and, you know, we're seeing rates at about 4%. So, you know, the landscape can change pretty quickly, pretty dramatically, depending on who says what from a political standpoint of view. So,
but what are people tending to do?
Yeah. So in terms of what people are doing, I mean, at the moment, we will say more people are more geared towards taking a fix. in kind of the October, November time period when the market turmoil hit, we probably done about 30% of our cases were about tracker products, which compared to what we're usually historically used to of about 3% of our applications being historic, that's kind of increased tenfold during that kind of period of uncertainty because people didn't know what was going to happen. So, and it was the right thing at the time because tracker rates were significantly cheaper because the base rate hadn't moved up quick enough and we're tracker rates. Sorry.
I wonder if those people that you helped back end of last year who got tracker rates, are they now converting to fixed?
Yes. Yes, many of them will be, but again, many of them took out that tracker mortgage because they are looking to sell their property, or they wanted to see what happens in the market over the kind of a longer period of time. So, yes, a good element of those customers have reverted back to us, where we, through our kind of algorithms and our system, we can establish it's actually cheaper for them to now move on to fixed. We offer them that option.
Got it. And is there much of a variance between the rates, the mortgage products, between a 2-year fix and a 5-year fix at the moment?
So the margins aren't as probably as significant as they probably were 6 months ago, but you will get a bit of a margin between them. So 5-year fix is going to be a cheaper option for a customer.
Cheaper?
Yes.
Is
I know, yes. So
cheaper than a 2-year fix?
Correct. Yes.
Wow.
And that's normally by, you know, at least 0.25%. It's normally cheaper.
Isn't it usually the other way around?
It used to be, you know, when we was looking at when I first took out my mortgage, 2-year fix would have been cheaper than a 5-year. But again, a lender's driven by what we call swap rates. And again, I don't want to get too technical with it.
Go on.
But essentially, a swap rate is a future predicted rate, which is essentially the cost of what, you know, banks or Bank of England self-funding to lenders for. And they're driven by what that rate is. So although the base rate is where it is, the reason why lenders have got lower rates than the base rate is because they're driven by the swap rates. And that changes on a daily basis because it's a future predicted rate. And that, you know, at the moment is floating just under 3.6% as of today. So with the swap rate being in a half decent place, and that's, you know, as I said, the cost of funding is where, you know, is what drives that for banks and lenders and builder societies.
Comforting words from Sam.
Yeah.
What about deposit levels for first-time buyers? Where are they sitting just at the moment?
So our average is roughly about 15% as a business. Most of our consumers have got 15% deposit. That's our average across the market. However, there are lenders out there that still do 5% deposit mortgages. So, you know, if someone doesn't have the 10%, 15%, which gives them a slightly better deal. There are still options out there for you to get a mortgage on a 5% deposit.
But probably not much of a deal.
I mean, as I said, it's still cheaper than renting.
Any advice or thoughts on people coming to the end of their rates?
Yeah, so I know many people will be coming to the end of their fixed rates, looking to tie into a new deal. I mean, first things first, make sure you do speak to a mortgage broker. I think advice today is more vital than any kind of period we've had over the last kind of 8 to 10 years. And it's important you kind of have all your options on the table. A couple of options out there is, the first one is you can look to extend your mortgage term. Now, of course, you will pay, you know, more interest over time by extending your mortgage term. But if it allows you to kind of continue with your kind of current lifestyle and bring the payments down for kind of a short period of time once we're kind of going through the higher rates that we're at, then that's an option for you. Alternatively, and a lot of people won't know this, but, you know, when I first started off in the mortgage industry about 9 years ago or so, offset mortgage were really kind of important and played a massive factor back then. So, and the reason why is because they're quite cost effective from a tax point of view. So if you're a high rate tax earner and you've got substantial amounts of savings, normally you pay interest on those savings. You pay tax on the interest that you obtain from those savings, sorry. Instead, what you can do, if you've got a good amount of savings, is you can offset it against your mortgage. So if, for example, you've got a mortgage rate on an offset product, which is a 4% rate, but you offset 50% of your mortgage balance against your savings into an offset account with that lender, in theory, you're paying interest on half of the mortgage balance. So that 4% rate that you will be paying, you're only paying it on half the mortgage balance, not the full amount. So it's a great product to utilize, and I think it's a product that's probably going to grow this year as rates have obviously increased. You know, when rates
you're seeing more of them, are you?
We haven't started seeing more of them yet because we haven't really seen the consumer come off the rates yet. You know,
Okay.
we start seeing it more towards the back end of the year.
Yeah.
That's the highest roll-offs are more towards the back end of the year, which is when we'll probably see more consumers looking for alternative options.
I should actually say at this point, Sam, I've got one. I've got
What's
a
it?
second mortgage,
Right.
and I think that they are super useful for people, who sales teams and that, you know, who have commissions or dividends or chunks of money coming in at different times. There's no point paying a debt if you've got money, if you're in credit.
Correct.
So it's a kind of daily interest rate. I view it.
Yeah. It's a great product, and you know, as I said, 8-9 years ago, they were very popular when rates were similar to what they are today. And I do feel that they'll play a big part again at some point this year.
Good. Sam, really appreciate your time. I know it's a busy time for you, and there's a lot of people looking for advice. So I think that is a nature of when the market and things are fluctuating, and there's a lot of moving parts. There's a lot of variables at the moment. That is when people really need advice. So really appreciate it. Thank you so much.
No, it's a pleasure.
A few words of warning. Your home may be repossessed if you don't keep up repayments on your mortgage. You may have to pay an early repayment charge to your existing lender if you remortgage. Individual savings may vary.
And thanks again for tuning in.